So let's review chapters 4 through 6. So, starting off with chapter 4. The start of chapter 4, what chapter 4 is all about is closing entries. So at the end of the accounting cycle, you have to close your books. And so that means you have to close revenue accounts, you have to close expense accounts, and you have to close your owner's drawings. So we have this problem for us here with an adjusted trial balance, and we need to prepare the closing entries. But before we dive into that, let's just talk about what the closing entries are. So you're going to start off by closing your revenues and then closing your expenses to income summary. So income summary is this new account that pops up here in chapter 4. It's just this placeholder, let's say, where we close our revenues and we close our expenses too. So the first step is to close revenues. Second step is to close expenses. Once we've done that, we then need to close our income summary to owner's capital. So that's step number 3. And then our final closing entry is to close owner's drawings to owner's capital. So if we can remember all of these steps, closing entries won't be too terrible. So we have this information over on the left, all of our accounts and their balances. The first step we said was to close our service revenue. So we take a look at our service revenue and we see that it has a credit balance of $4,300. Well, to close out an account, what we're trying to do is get its balance down to 0. So if an account has a credit balance, to zero out that account, we're going to need to debit service revenue. So we will debit our revenues, and then we said that we were closing our revenues to income summary. So we credit income summary. Now, for how much? Well, service revenue has a balance of $4,300. So that's the amount that we're going to debit service revenue for. And since our debits and credits need to equal, that's also the amount that we credit income summary for. So we've now closed our revenue accounts. We only had one. The next step is to close our expenses to income summary. Well, we have 3 different expense accounts. We have salaries and wages, miscellaneous, and supplies. And expense accounts have a normal debit balance. So to close an expense account, we will need to credit all of our expenses. So we credit salaries and wages expense, credit miscellaneous, and credit supplies expense. But then the account that we're going to debit is where we close them to. So if you recall that flow chart that we had on the last slide, we close our expenses to income summary. So we will debit our income summary and credit all of our expenses. Now, how do we figure out the amounts? Well, we credit the expenses for the amounts that are listed on our adjusted trial balance. So salaries expense was $1,260, miscellaneous was $256. Right, so we just copy those over into our closing entry. Now our income summary, that's going to be the sum of our 3 expenses. So if you add up your 3 expenses, you end up with $3,416. So we'll debit income summary $3,416. Now, the third step was to close our income summary to owner's capital. So we need to figure out what the balance in income summary even is. So we set up a T account. We had a credit of $4,300 and a debit of $3,416. So its balance right now is a credit balance of $884. So in order to close out income summary, we have to do the opposite of what its balance currently is. So we need to debit income summary to close that account. And we close income summary to owner's capital. So we will debit income summary, the $884, and then we credit owner's capital $884. Now our last step is to close owner's drawings. Well, owner's drawings, if we take a look at our adjusted trial balance, has a debit balance of $550. And to close out an account that has a debit balance, we need to credit that account. So we'll be crediting owner's drawings, and we know that we close that account to owner's capital, so we will debit owner's capital. Now to get our number here, we look at the balance of the drawings account. So that's $550. Because we need to credit owner's drawings $550 to close out that account. So you'll notice we never did anything in our closing entries with owner's capital's $5,760 balance. That balance will be changing because we did affect the owner's capital account, but we never close owner's capital. Owner's capital is a permanent account, and so since we never close that, it doesn't really matter what we started with when we're doing these closing entries. So the framework for your first, second, and fourth entry are always going to look the same. You'll always debit revenues, credit income summary. Debit income summary, credit expenses, and debit owner's capital and credit owner's drawings. Your third closing entry, that's one that could flip. So if we found out that we had a debit balance in income summary back when we did the T account, we would have had to credit income summary to close it. And so in that case, you would flip your income summary and your owner's capital for that third closing entry. So let's look at problem number 2. So problem number 2 brings on chapter 5. So in chapter 5, you learned about the journal entries for a merchandising company. So we will eventually have to prepare the journal entries for Jones Company and then prepare the journal entries for Taylor Company. I would recommend taking a picture of the screen right now, so in that way you have all of the information here of the transactions. So that way when we're making the journal entries, you know where these numbers are coming from. So this problem says on October 10th, Jones Company purchased $7,000 of merchandise from Taylor Company, FOB shipping point, terms 210, net 30. The goods cost Taylor Company $3,000. So let's break that down a bit. So Jones is buying merchandise from Taylor Company. So Jones will be the buyer, Taylor will be the seller in this case. FOB shipping point. What that means is that the buyer will have to pay for shipping. If it was FOB destination, then the seller would have to pay for shipping. Now we have terms 210 net 30. So that's saying that Jones can get a 2% discount if they pay within 10 days, or they have to pay the net. They have to pay all of it within 30 days. So whenever we're given terms like this, that also means that this purchase was made on account, right? Because if they used cash, well, they're not paying anyone back within 10 days, right? So whenever you see terms, that means that we're dealing with accounts payable, accounts receivable, depending on which side of the transaction we're on. And then the goods cost Taylor Company $3,000. So Taylor's the seller. So these goods that were involved in this sale cost them $3,000 to originally acquire. They're selling it to Jones for $7,000. Right? So when we're making the journal entries on the books of Taylor Company, then we worry about what the goods cost Taylor. And we'll get to that point later on in this problem. Our next transaction, Jones pays the freight cost of $350 on October 12th. So Jones, the buyer, is paying for shipping, right? Just like we talked about with FOB shipping point. Then, on October 15th, damaged goods totaling $500 are returned to Taylor for credit. The fair value of these goods is $50. So there was some damaged goods in this original purchase. Jones is returning them to the seller. And then the fair value, that's what Taylor Company is able to resell these damaged goods for, right? Maybe for scrap metal. They can get $50 for it. So that's what the fair value means. And then on October 19th, Jones pays Taylor in full, less the discount. So let's first prepare the journal entries on the books of Jones Company. So on October 10th, Jones Company purchased $7,000 of merchandise from Taylor, FOB shipping point, terms 210 net 30. So what are they getting in this? Well, they're getting inventory, right? Jones Company's purchasing merchandise. So they are increasing their inventory with this debit. And then how are they paying for this inventory? Well, we said earlier that any time that there were terms, that meant it was on account. So we'll credit accounts payable for $7,000. The goods cost Taylor Company $3,000. Well, we are the buyer in this case. So we probably don't even know what these goods were supposed to cost Taylor Company. So we don't have to journalize that 3,000 portion here. Next, on the 12th, Jones pays the freight costs of $350 on October 12th. Well, whenever the buyer pays for shipping, they count that under inventory because it cost Jones an additional $350 to get this inventory, right? So that was just part of the cost of acquiring this merchandise. So we throw it into inventory with this debit. Now, how are we paying for the freight costs? Well, it tells us Jones pays the freight costs right now. So we're going to use cash. If it told us that it was on account, then we would use accounts payable, but the vast majority of the time, whenever you pay for shipping, you're paying for shipping right now. Now on the 15th. So damaged goods totaling $500 are returned to Taylor for credit. The fair value of these goods is $50. Well, so we're the buyer. We're Jones Company. We don't care about the fair value. I don't care what Taylor Company can get for these damaged goods. All I care about is the $500 of goods that I returned. And so if I return goods, that means I don't have to pay for them anymore, right? So we want to decrease our accounts payable to show that we don't owe that money anymore, because we've now returned these goods back to the seller. So we debit our accounts payable. Now, we also want to credit our inventory, because we don't have those $500 worth of goods anymore, right? So we want to decrease our inventory account by the amount that we returned to Taylor Company. Like I said before, we don't worry about the fair value. The fair value just comes into play for the seller, not for the buyer. So now we're on to the 19th. On the 19th, Jones pays Taylor Company in full, less the purchase discount. So, if we are paying Taylor Company back, that means we don't owe them anymore after this, right? So we want to decrease our accounts payable. Now let's talk about that $6,500. So you will want to keep track of the balance in your accounts payable as you go through a problem like this, right? Back on the 10th, we owed $7,000, but then on the 15th, we returned $500. So subtracting those two amounts to find the balance in accounts payable, that's how we got the $6,500. So we're paying these people back. It's within the discount period, right? The terms were 210 net 30. So we paid within 10 days, so we get that 2% discount. So that's where this inventory comes into play. So the buyer will count a discount under inventory, for the same kind of idea as to why we counted shipping under inventory. A discount decreases the amount of money that we had to pay for our inventory, so we will credit our inventory for the discount amount. Now, how do we get the 130? Well, we owed $6,500 on this day. We get a 2% discount. So we take 6,500 times 0.02, and that's how we get this 130 that we're crediting inventory for. So if you owed 6,500 and you get a $130 discount, that means that you have to pay $6,370, right? So we credit our cash for the difference between your accounts payable and your discount. So those are your journal entries from the Jones Company perspective, from the buyer's perspective throughout this problem. So now we can take a look at what the journal entries would look like on the books of Taylor Company. So, on October 10th, Jones purchased $7,000 of goods from us, from Taylor Company. Terms 210 net 30, and the goods cost Taylor Company $3,000. So when you're the seller, you'll notice that there's a lot of times that you have to make two entries. Whenever you make a sale, that's one of those times. You first have to make an entry to record the credit sale. So that's to show the amount of money that Jones Company owes you. So let's record that first. So they purchased $7,000 of goods from us, right? So they now owe us $7,000. The account that we use when someone owes us money, that's accounts receivable. So we debit our accounts receivable for $7,000. Now, why do they owe us this money? Well, we made a sale, right? So we need to credit our sales revenue for $7,000. So that's going to be the first entry for when you're the seller and you're making a sale. Now the second entry will also happen on the 10th, right? Everything's happening here on the 10th still. This is where the $3,000 comes into play. So what we need to do is we need to record the cost of goods sold. So cost of goods sold is an expense account. So we will debit our cost of goods sold for $3,000, and then we will credit our inventory for $3,000. Because if we're selling these goods to Jones Company, that means that we now have $3,000 less of goods back at our warehouse, right? So we credit our inventory for that $3,000. So whenever you make a sale, you're going to have two entries just like this. Now, the next piece of information that we're given is Jones pays the freight costs of $350 on October 12th. Well, if we're Taylor Company, we don't care that Jones is paying the shipping right now. It doesn't affect anything on our end. So, we don't even journalize that transaction because that transaction doesn't affect our company. So now we can move on to the 15th. On the 15th, damaged goods totaling $500 are returned to Taylor for credit. The fair value of these goods is $50. This is another time where we're going to need two separate entries. We first need to record the $500, and then we need to record the $50. So, whenever a customer returns goods to you, you will debit an account called Sales Returns and Allowances. So Sales Returns and Allowances is a contra revenue account. So it increases with this debit. If we were to try to find our net sales, we would take our revenue minus Sales Returns and Allowances. So our Sales Returns and Allowances goes up with this debit of $500. And then if we think back to the entry that we made for Jones Company on this day, when we said that we didn't owe that money anymore because we returned something, right? So now we can think of it from the seller's perspective. They don't owe us $500 anymore, right? They returned $500 worth of goods. So we need to decrease the accounts receivable by that $500. Because that $500 worth, we're not going to collect from them. So that's the first entry on this day. Then we have another entry. This other entry is to record the fair value of these goods. So we're told the fair value of these damaged goods is $50. So we are getting back $50 in inventory. Right? $50 worth of goods are now back in our warehouse. So we want to increase our inventory by 50. But what made that inventory get back to our warehouse? Well, we didn't actually sell it. Right? If they're returning it to us, we didn't actually make that sale. So we have to decrease our cost of goods sold by that $50. So you'll notice your entries on the 15th look pretty similar to your entries on the 10th, right? Accounts are kind of just flipped. So when there's a return, that's the opposite of making a sale. And so your entries have to show that as well. Now we have one last transaction. Here on October 19th, Jones pays Taylor Company in full less the purchase discount. So what are we getting as Taylor Company? We're getting cash, right? And we'll touch on the numbers at the very end. So we are getting cash, so we will debit our cash. But we're also giving them a discount because they paid within 10 days. So they're getting a 2% discount. And the seller will count a discount under an account called sales discount. So we debit sales discount as well. And then we credit accounts receivable. Because if they owe us money and then pay us back, their accounts receivable has to decrease. Right? We are decreasing their accounts receivable here to show that they don't owe us any more money. So the way we would want to calculate these numbers is pretty similar to the way that we did it for Jones Company. First, find your accounts receivable amount. So this is where maybe a T account for accounts receivable would come in handy, right? Where on the 10th you debited accounts receivable for $7,000. And then on the 15th, you credited that account $500. So its balance on the 19th becomes $6,500. So that's the amount that we'd want to credit for accounts receivable. Then find your discount. So there's a 2% discount in this problem because it's terms 210 net 30. So 2% of 6,500 is 130. And then find your cash. So if you take 6,500 minus your discount of 130, you get 6,370. So those are your numbers, your problem here on Part B when we're preparing the journal entries on the books of Taylor Company. So now let's take a look at problem number 3. So problem number 3 is for Chapter 6. So Chapter 6 deals with perpetual inventory methods, right? We had FIFO, LIFO, and moving average or average cost. Well, so we have all of this information given to us. We're told that on September 1st, we had a beginning inventory of 200 units at $5 a piece for a total cost of $1,000. On the 12th, we made a purchase of 400 more units at $6 a piece. On the 23rd, we made another purchase of 300 units at $7 a piece. And then at the end of the month, we should end up with 100 units. Then it tells us, assume a sale of 440 units occurred on September 15th for a selling price of $8, and a sale of 360 units on September 27th for $9. Now, when you are working on a FIFO, LIFO, average cost type problem, do not worry about those selling prices. Those selling prices are only there to help you figure out sales revenue. That's the only time that we would have to worry about the selling prices. In a problem like this, it tells us calculate the cost of ending inventory and cost of goods sold using FIFO, LIFO, moving average. So when you're trying to figure out ending inventory and cost of goods sold, I want you just to cross off those selling price amounts, right? For a selling price of $8, that's useless information to us, right? The $9, useless information. So we don't worry about those selling prices. So let's first work on FIFO. So FIFO stands for first in, first out, right? So the inventory that came in first are the first ones, the first units that we're going to push out the door. And we're going to set it up looking like this. where we have the dates over in the far left, and then we have a beginning inventory and purchases column, then a cost of goods sold column, and then an ending inventory column. And if we write it out and keep it organized, this problem gets a lot less overwhelming, a lot less scary, right? So on September 1st, we were told there was a beginning inventory of 200 units at $5 a piece. So we're going to write that under both beginning inventory, and then that was also our ending inventory on that day, right? At the end of the day on the 1st, we had 200 units at $5 a piece. So we write that under both beginning inventory and ending inventory. Now, on the 12th, they told us that we make a purchase of 400 units at $6 a piece. Well, purchases have to go over in that first column, right? So we will write over in our first column, 400 at $6 equals $2,400, right? Because that was our purchase there on the 12th. Now we can take a look at what our ending inventory looks like. We ask ourselves, do we still have those 200 units at $5? Yes. We never sold any of those between the 1st and the 12th, right? So we want to rewrite out 200 at $5 equals 1,000 because we still have that in our inventory. And then below that, we can write out 400 at 6 equals 2,400, right? So we have a total of 600 units right now. 200 are valued at $5 a piece. 400 units are valued at $6 a piece. So we have these two separate groups, and we want to keep them separate when we're doing FIFO and LIFO. So then that way we know, okay, which one came in first, which one came in last. Because here on the 15th, we're about to make a sale. And so we will need to know which units came in first, because those are the units that we're going to want to sell first. So on the 15th, we were told assume a sale of 440 units occurred. Well, under FIFO, first in, first out. So the first units that we want to sell are those 200 units at $5 a piece. So let's say we sell all of those. The total number of units that we had to sell was 440. So 440 minus 200, well, that means we still have to sell another 240 units. So this is how it's going to look here on the 15th. We first sell those 200 units at $5 a piece. Those have to go out of the warehouse because those were the first ones to come in. Then we still have to sell another 240 to reach that 440 unit order. Those 240 come from the next inventory group to come in. And those happen to be the units that we value at $6 a piece. So 240 units at $6 a piece, you multiply that out, you get the 1440. Now, looking over in the ending inventory column, we ask ourselves, do we still have the 200 units at $5 a piece? No, because we sold all of them here on the 15th, right? So we don't have any units left at 5. Do we still have units left at 6? Well, we had 400. We sold 240 of them. So 400 minus 240 leaves us with 160 units. So we still have 160 units at $6 a piece. And 160 times 6 will get you that 960. Now we can move on to September 23rd. So on the 23rd, we make another purchase. right? It tells us 300 units at $7. Well, this is going to look pretty similar to what we saw back on the 12th. We write out our purchase under our purchases column. 300 at $7 equals $2,100. Then we want to go over to our ending inventory. We still have those 160 at $6 a piece. So we need to write all of those down under our ending inventory. Then we just purchased 300 more. So we have 300 more at $7 as well. So after this purchase on the 23rd, we had a total of 460 units. Right, 160 plus 300. Now on the 27th, we sold 360 units. So again, first in, first out. So the first ones that we want to sell are these units at $6 a piece. So we first sell all 160 at $6. And then we realize we still need to sell another 200 in order to reach our order of 360 units. So those 200 come from the inventory group valued at $7 a piece. So we write out 200 at 7 under cost of goods sold as well. Now we can look over in our ending inventory and we ask ourselves, do we still have units left at $6? Well, we had 160 and then we sold all 160. So no, we don't have any units left at $6 a piece. Do we still have units left at $7 a piece? Well, we had 300 and we sold 200. So yes, we still have 100 units at $7 a piece. And you'll notice that on September 30th, we're supposed to end up with 100 units. So now that we've done all of this work, now we can start answering the questions that they were asking us. They wanted to know the cost of goods sold. So we have our cost of goods sold column, right? How we find our cost of goods sold is adding up all of the total amounts under the cost of goods sold column. So the 1,000, the 1,440, the 960, and the 1,400. And if you add all of those up, you'll end up with a cost of goods sold of $4,800. Now, we also needed to find our ending inventory. Our ending inventory is even simpler than finding our cost of goods sold. Our ending inventory, we take a look on our last day, and we see that our ending inventory is worth a total of $700. So that 700 is our ending inventory. So we'll make note of those two amounts, our cost of goods sold and our ending inventory under FIFO. Because at the end of all this, we're going to compare between FIFO, LIFO, and moving average, these cost of goods sold amounts and these ending inventory amounts. So that's FIFO. Part B wants us to do LIFO. So we'll do it all over again, right? On September 1st, we had a beginning inventory of 200 units at $5 a piece. So we write it out again. Right? That's our beginning inventory and our ending inventory on that day. On September 12th, we made a purchase of 400 units at $6 a piece. So we write that under our purchases, 400 at $6, and then our ending inventory, we still had those units at $5 a piece, but now we also have units at $6 a piece. So we write out both of those groups of inventory over in that last column. So far, it hasn't changed compared to FIFO, right? FIFO and LIFO are going to divert from each other once you make a sale. So here on the 15th, we're making a sale. We are selling 440 units. This is where LIFO is different from FIFO. So LIFO stands for last in, first out. Well, the last units that came in were those units at $6 a piece. Right? So if we have to sell 440 total units, we're first going to sell all 400 at $6, and then we still have to sell another 40, and that will just come from our other inventory group. So we sell all 400, all that we can of those at $6 a piece. They still wanted another 40 units. Those 40 come from the units at $5 a piece. Now we take a look at our ending inventory. And we can say, okay, do we still have any units left at $5? Well, we had 200, we sold 40, so we have 160 left at $5 a piece. Do we have any units left at $6 a piece? Well, we had 400 and we sold 400. So no, we don't have any left at $6. Right? So we only have 160 units left at $5 a piece after our sale on September 15th. So now the 23rd rolls around. And on the 23rd, we made another purchase. Right? This purchase of 300 units at $7 a piece. So we write that under our purchases column. 300 at $7 equals 2,100. Then we go over to our ending inventory. We had 160 at $5, so we still want to write that down to show that we still have that. But now we also have another 300 at $7. So we have two different groups of inventory here after our purchase on the 23rd. And now the 27th. So on the 27th, we made a sale of 360 units. So what we're going to do is, it's last in, first out. So we're going to sell all 300 units at $7 a piece. Those were the last ones that came in, so they're the first ones that we push out here on the 27th. But our customer wanted 360 units. So then we have to dip into those units that we had at $5 a piece, and we had to sell them 60 of those units. So we can then look over at our ending inventory. We can say, okay, did we have any units left at $5? Well, we had 160, and then we sold 60. So that leaves us with 100 units at $5 a piece. And then we can look and say, okay, do we have any units left at $7 a piece? We had 300, and we sold 300. So no, we don't have any units left at $7 a piece. So on the 27th, we had 100 units at $5 a piece. So you'll notice at the end of the month, we ended up with the same number of units under LIFO as we did FIFO. The difference is how we value them. Right? Here in LIFO, we valued these inventories or these 100 units at $5 a piece. In FIFO, they were $7 a piece. So now we can figure out our cost of goods sold and our ending inventory. If you recall from how we did it with FIFO, for cost of goods sold, we take the total amounts in our cost of goods sold column. So we take our 2,400, we add in the 200, add 2,100, and add 300. You add up those four amounts and you get $5,000 as your cost of goods sold. Now, for ending inventory, we just take a look at our last day, right? On the 27th, we had 100 units at $5 a piece. They were valued at a total of 500. So that 500 is your ending inventory. Now we can take a look at average cost, or moving average. So under this method, it changes from FIFO and LIFO in a few different ways. So LIFO looked just like FIFO until our first sale, right? Average cost is going to look the same up until the first purchase. So that's number one. The other main difference is we don't keep our inventories separate. So just like how we had on the 23rd, we had two different groups of inventory under LIFO. We're not going to do that here under average cost. We're going to combine our inventories. So let's work through this problem. Here on September 1st, it's our beginning inventory. Beginning inventory doesn't matter if you're using FIFO, LIFO, average cost, whatever. Your beginning inventory is your beginning inventory. Right? So we just want to write that out again on September 1st. Now, here is where things are going to change. On the 12th, you purchased 400 units at $6 a piece. We still want to write out that 400 at 6 over in our purchases column. So we write that out over there. But then you'll notice over in ending inventory, things look different, right? We've combined our inventories. So there's a process to figuring out all of those numbers. What you'll want to do is first add up your total number of units. So you take the 200 units that you had, and you add in the 400 units that you just purchased. So 200 plus 400 equals 600. So that's how we get that 600. That's the total number of units that you have on the 12th. Then we write an @ sign, and we'd want to leave some space and put in equals. The next number that we're going to calculate is the total value of our inventory, that 3,400. How do we get that? Well, we take a look back on the 1st. In our ending inventory, we had inventory worth $1,000. Then we purchased on the 12th inventory worth $2,400. So 1,000 plus 2,400 gets you 3,400. So if you're writing this out on paper, you would have 600 at, then you would leave some space, put an equal sign, 3,400. Now we need to find this average unit cost. And to do that, we take 3,400, we take our total value, and we divide it by our 600, which is our total number of units. So the total value of your inventory divided by the total number of units that you have will get you your average unit cost. So 3,400 divided by 600 gets you $5.67. So we are now going to be valuing our inventory, each unit, at $5.67. Now there's a few ways to make sure that we are on the right track here. First of all, it needs to be between the two unit costs that we are averaging, right? We had units at $5 and we had units at $6. Well, it needs to be somewhere between those. So we're good, right? It can't be below 5 and it can't be above 6. But why isn't it just $5.50? Well, you have more units at $6 than you do at $5. So it's a weighted average. So we have to be closer to 6 than we are to 5, because we have more units at $6 than we do at $5. So those are just a few checks for you as you're going through a problem like this. Now on the 15th, we sold 440 units. Here's the beautiful part about average cost. It's a lot simpler when you make a sale, right? We made a sale of 440 units. So, under cost of goods sold, we'll put 440 at $5.67. That's our most recent average unit cost. We multiply that out and we get the $24.93. You'll notice the average unit cost doesn't change when you make a sale, right? Because then our ending inventory on the 15th, we had 160 units left at $5.67. So, purchases, there's some extra work compared to when you are doing just FIFO and LIFO, but a sale is simpler under average cost. So now on the 23rd, well, on the 23rd, you purchased 300 more units. So 300 at $7 equals $2,100. That goes over in our purchases column. And then we need to work on our ending inventory. So remember, there's this process. First, we need to find our total number of units. So we had 160 units, and then we just purchased 300. So 160 plus 300 gets us our 460 units. Then we want to write an @ sign, leave some space, and write an equals. This is then when you calculate the total value of your inventory. So we take 907 and we add in 2,100. So 907 plus 2,100 gets you 3,007. Now we can find our weighted average unit cost. This is when you take the total value of your inventory and divide it by your total number of units. So we take 3,007 divided by 460. So 3,007 divided by 460 gets you $6.54. And again, we can check ourselves. It has to be between 567 and 7. And we are. So we may not be correct, but we at least know that we are in the right ballpark. Now, on the 27th, we made a sale of 360 units. So, we'll write out 360 units at $6.54 equals $23.54. Then we go over to our ending inventory. And we had 460 units. Then we just sold 360 of them. So we're left with 100 units. And average unit cost does not change with a sale. So it stays at $6.54. So 100 at $6.54 equals $654. So now we can calculate our cost of goods sold and our ending inventory for average cost. It's going to be the same process as we did for FIFO and LIFO. So for cost of goods sold, we're just looking at our cost of goods sold column. We want to take those two total amounts, the $24.93 and the $23.54. We add those together and we get a cost of goods sold of $48.47. Now, our ending inventory. So we take a look on the 27th and we see that our 100 units are worth a total of $654. So our ending inventory is just that $654. So we said earlier that we were going to make note of all of these cost of goods sold and ending inventory amounts, and then compare them to each other at the end. Let's do that now. So we have our cost of goods sold and ending inventory for FIFO, LIFO, and average cost. There's a few things that we can notice here, right? So under FIFO, you have a lower cost of goods sold, and cost of goods sold is an expense, right? So a lower cost of goods sold is going to give you a higher net income. Sounds perfect, right? We want our net income to be as high as it possibly can. That's going to attract investors. So why would you ever be interested in this scenario? A higher cost of goods sold under LIFO that then would get you a lower net income. Well, if we had a lower income, that also means that we have a lower amount of taxes that we have to pay. And so LIFO will decrease the amount of taxes a company might have to pay on their income. Now, a company is not just going to be flip-flopping between these different inventory methods year after year, because they're going to have to go back a few years anytime they make a change from FIFO to LIFO or LIFO to average cost. They have to go back and redo all of their financial reports to show, okay, what would our financial reports have looked like if we were using this new method 2 years ago? So these changes aren't going to constantly be happening. So a company is probably going to just pick FIFO or LIFO or average cost, and they're going to stick with it as much as they can because it's going to be simpler. But there are some reasons as to why they would want to pick one over the other.